Hello, everyone. My name is Abby Goldstein, and this is session 7 assignment. And today I'm going to be presenting our analysis for the required returns of three potential venture capital investments using the capital asset pricing model, or CAPM. Our mission was to evaluate three companies with drastically different risk profiles: a high-flying tech startup, a stable regional bank, and a regulated utility to determine the cost of equity. We followed the driver framework to guide our analysis. The starting point for any CAPM analysis is the market context. We use the following inputs based on our current market data: the risk-free return, which was 4.5% based on the 10-year Treasury, and then the historical market premium or risk premium, the MRP, which was 6%, which gives us an expected market return of 10.5%. So now we're going to dive into our core analysis. So I'm going to run the code. So this is the output. The CAPM formula, risk-free rate plus beta plus MRP, which gives us our required return. We see a clear direct relationship between beta and cost, right in this chart too. And we also have a graph. Cloud tech has the highest required return because investors need to be heavily compensated for its high systematic risk. So the next question we were asked was, why do these betas differ so much? It comes down to two key factors: operational leverage and financial leverage. Cloud tech, which has a beta of 1.8. This high beta is driven by the high operational leverage, the need for high fixed costs like R&D and sales teams. This makes its profits highly sensitive to even small changes in the economy. Next, regional bank, which has a beta of 0.9. While its core business is relatively stable, its beta is kept high by financial leverage. Banks use significant amount of debt and deposits, which magnifies the equity risk. And then the green energy utilities at beta has a beta of zero point 0.5. This is the ultimate defensive stock. It regulates revenues and essential services, meaning it has low operating leverage, making its cash flows stable regardless of the market. The third question was, how can cloud tech lower its cost of capital? Since it is 100% equity finance, we focused on two areas: to reduce its beta and introduce modest debt. Cloud tech can reduce its cost of equity by shifting its cost structure away from fixed costs and towards variable costs, thus lowering its operational leverage. And then introducing modest debt, by adding a manageable amount of debt, cloud tech can lower its overall WACC. Debt is cheaper than equity, and the interest payments are tax deductible, creating a valuable tax shield. And then finally, we were asked, how would a recession affect the required return? We ran a stress test on Python, assuming a 1% rise in the risk-free rate and a 1% rise in the MRP due to heightened volatility. So the code gave us another chart right here. The high beta company, Cloud Tech, is affected the most, seeing its required return jump by 2.8 percentage points. This confirms that the most violent companies are penalized in the hardest when the market risk increases. Green energy, which was most resilient, with only a 1.5 percentage point increase. In reflection, while the CAPM is essential for quantifying market risk, it has limitations, especially in the context of our startup investments, like YC companies. CAPM is a single factor model. It ignores crucial factors like the small firm effect and a liquidity risk associated with private or small cap stocks. Venture capitalists require returns far higher than CAP. The CAPM often predicts sometimes 20% to 50% to account for this massive risk of failure that is not fully captured by its simple beta. And this was my analysis, so thank you for listening.